A market crash far worse than 2008 is coming, and the American consumer is already living on borrowed time. That is the latest warning from Peter Schiff, one of the most famous financial analysts alive, in his latest interview. If you do not know who Schiff is, you need to. He is the economist who publicly called the 2008 financial crisis years before it happened, while almost every mainstream analyst was denying a housing bubble even existed. He's been warning about the US dollar, the national debt, and asset bubbles for over 25 years. He is the founder of Euro-Pacific Asset Management and the author of multiple best-selling books on economic collapse. In this interview, he warns that housing is more overpriced than ever, that stocks are in a bigger bubble than 2008, that a US dollar collapse is coming, that oil could hit $150 a barrel, and that the shelves in American stores are going to go empty. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you are getting value from the videos, hit that subscribe button. It is free, it supports the channel, and you can always change your mind later. Now, here is exactly what he said.
The American consumer is already living on borrowed time. They're leveraged to the max. They live paycheck to paycheck. They can't even live on their paychecks. They're living on debt. Because I think we have a bigger bubble now in housing, in stocks, in bonds, in the economy than the one we had then. The dollar's going to collapse. The shelves are going to be empty. Oil could be $125, $150 a barrel. In that environment, we have to be in a recession. I don't know, any day. I think we're close. The same people that were blindsided by the 2008 financial crisis are blind to the crisis that we're headed for, which will be worse than that one. Because I think we have a bigger bubble now in housing, in stocks, in bonds, in the economy than the one we had then. And we certainly have a lot more debt now, a lot more debt than we had in 2008. So it's a much bigger bubble, and it's going to be a lot more devastating when it pops. But I think this time it's going to be a currency crisis, U.S. dollar crisis, a sovereign debt crisis, which is a lot worse than, a mortgage crisis. But these low interest rates allowed people to bid up home prices. And as a result, housing affordability is lower now than it was at the peak of that prior housing bubble. So houses are more overpriced now than they ever were in 2005, 2006.
Relative to a salary, right?
I think Americans have more debt now than they did then. When you also look at student loans and credit card debt and auto loans on top of the mortgages, I think the society, the nation as a whole, has a lot more debt. And now, look, what did Fannie and Freddie just announce today? They're lowering their requirements regarding insurance. When the loans go into default, the properties have lower value when they get sold. And that's bigger losses for the GSEs and ultimately the taxpayers. There's a bubble, not just in residential. There's a bubble in commercial real estate, which is much bigger than any bubble that we had. And I don't even think we had a commercial real estate bubble last time, but we do this time. When you look at residential and commercial properties, this is a far bigger bubble. But, at the same time, the stock market is more overvalued now than it was in 2008. And back in 2008, I forget what the national debt was. It was less than 10 trillion. I think it could be 50 trillion before Trump finishes his term. If we go into a big recession and we continue to have the war in Iran, we're going to hit 50 trillion.
So there is Peter Schiff laying out the case that the coming crash will make 2008 look like a warm-up. And the numbers right now are confirming almost every piece of his thesis. Start with housing. Redfin just reported that there were nearly 630,000 more sellers than buyers in the US housing market last month. That is the largest gap ever recorded in data going back to 2013. Pending home sales have hit a record low. Homes are 30% overvalued according to multiple independent analyses. And Schiff is right about Fannie and Freddie. They are already lowering insurance requirements, which is the exact same kind of regulatory softening that inflated the 2008 bubble. On commercial real estate, the numbers are catastrophic. In January 2026, the delinquency rate on CMBS office loans hit 12.34%. That is the highest level ever recorded since tracking began in 2000. It is worse than the 2008 financial crisis. $930 billion in commercial real estate debt is maturing this year. Office vacancy nationally sits between 17 and 18%. In Denver, it is above 36%. A 50-story tower in Manhattan defaulted in January because the balloon payment could not be made. The regional banks that loaded up on these loans during the low-rate era are now directly in the firing line. On stock valuations, the Shiller-Cape ratio on the S&P 500 is sitting near 40, the second highest reading ever recorded. The highest was late 1999, right before the dot-com crash. The Buffett indicator, which measures total US market capitalization against GDP, is at 213%, the highest on record. Both of these metrics flagged the dot-com bust and 2008 before they happened. Both are flashing red right now. The S&P 500 is already down 4% on the year. All three major indices have broken below their 200-day moving averages. On the consumer, Schiff nailed it. Americans are now using buy now, pay later schemes for burritos. CNBC interviewed Americans at gas stations across the country this week. People in Los Angeles paying $7 a gallon. 86% of Americans now say gas prices are their top financial concern. Moody's confirmed that the top 10% of earners drive nearly half of all consumer spending. Deloitte says the bottom half of the economy is effectively already in recession. And on the national debt, the number is breathtaking, $39 trillion and climbing. Professor Steve Hanke and former US Comptroller General Dave Walker just published research in Fortune magazine showing the US government has $6 trillion in assets against $136 trillion in total liabilities when Social Security and Medicare are included. By any accounting standard, the country is technically insolvent. And Schiff is warning the world is about to figure that out. Now he goes deeper into the currency crisis angle. This is where the conversation gets really serious.
I thought that when the Fed slashed interest rates to zero and launched quantitative easing, that would eventually cause a run on the dollar. And that didn't happen yet. I think it's going to happen. So I was right on the primary effect, the banking crisis and the collapse in stocks and real estate. I just thought that the world would have ditched the dollar after we went to QE. But, that didn't happen. The dollar stuck around, and that's what enabled us to get into a lot more trouble. So now we have a much bigger bubble because it didn't really pop back then. We were able to bail us out by inflating a bigger bubble. But when that bigger bubble pops, then I think we get the real crash that I was writing about, back then. I mean, the world, I think, is already losing its appetite for treasuries and recognizes that we're not good for the money. We're not going to pay it back. Either we're going to default or we're going to inflate. But either alternative means you lose if you're a lender. Mm-hmm. So I think this whole thing is going to implode. And I think, Donald Trump really misread his hand when it comes to the cards that we hold in the global trading system. He thinks that, the world rips us off and takes advantage of us. And I think it's the other way around. The world gets the short end of the stick. We get to live beyond our means, and that's possible because the rest of the world is living beneath their means. I think the world's going to pull the rug out from under the U.S., and, the dollar's going to collapse, and the shelves are going to be empty. And a lot of the jobs that went along with distributing those goods are going to go away. Our biggest employers are Walmart, Amazon, FedEx, UPS. Those jobs, most of them don't exist without the foreign products coming in.
When does that happen?
I don't know. Any day. You don't know. I mean, as I said, we're living literally on borrowed time here. And Donald Trump poked the bear. So I think that he's accelerating a process that was already playing out much more slowly than I had believed it would ultimately. The 10-year Treasury yield got to 4.4 today, the highest or the first time it's done that since July of last year. And the 30-year yield is almost back up to 5%. We're like 4.95. So we're very close to a major breakdown in the bond market, which shows that money isn't moving into treasuries. Mm-hmm. Obviously, money is moving out of treasuries now.
So there is Schiff explaining why the next crash will not just be a financial crash, it will be a currency crash, a sovereign debt crash, a loss of global faith in the United States dollar itself, and the evidence is everywhere once you know where to look. Look at what foreign central banks are actually doing. They are dumping US treasuries at a historic pace. The Treasury Department's own international capital flow reports show foreign holdings under sustained pressure. and they are rotating aggressively into gold. Central bank gold purchases have hit record levels for 3 consecutive years. Russia, China, India, Turkey, Poland, all accumulating physical gold at unprecedented speed. And the gold market is responding exactly the way Schiff predicted. Gold is sitting above $4,650 an ounce, up over $1,600 from a year ago. Silver is above $75, up more than 140% year on year. Professor Steve Hanke, who called the inflation surge years before it happened, is now forecasting gold at $6,000 to $7,000 by the top of this cycle. Jim Rickards, who helped build the original petrodollar system while working with the Nixon White House, is forecasting $10,000 gold. The physical gold market is screaming that something has fundamentally changed in the global monetary system. On bonds, the damage is already visible. The 10-year Treasury yield just hit 4.4%, the highest since last July. The 30-year is approaching 5%. These are the rates that determine mortgage rates, corporate borrowing costs, and the cost of servicing the $39 trillion national debt. Every basis point higher costs the US government billions in additional interest payments. And the bond market is not reacting to the Iran war the way it normally would. In a classic flight to safety, yields fall as money rushes into treasuries. This time, yields are rising while money flees the dollar complex entirely. On the oil shock that Schiff warned could hit $150, the trajectory is in motion. Brent crude has spiked above $112 a barrel. The dated Brent price, the benchmark for actual physical deliveries happening right now, hit $144, the highest level ever recorded. The IEA has warned that this crisis could be worse than the oil shocks of the 1970s. Analysts at Macquarie Group say oil could spike above $200 a barrel if the war drags on through June. And the trigger shift describes the moment the world pulls the rug out from under the United States is one geopolitical miscalculation away. Here's how he sees the war in Iran playing into all of this.
I don't think the war is going to end because we win it. I think it's going to end because we just cry uncle. Of course, we're not going to, admit that we lost. We're going to claim that we won no matter what. They win by just outlasting our bombs. Because if Trump is committed to not having boots on the ground, eventually we're going to have to stop bombing and stop launching missiles. As Trump said, we're running out of stuff to destroy.
I mean, the biggest issue is the strait being shut, right? The strait being shut is that's losing the war de facto.
The longer the war costs money, not just because it raises certain prices, but because we have to spend all this money on the war. So where does that money come from? Where do we get this money? We have to borrow it. We have larger deficits, and that is pushing up bond yields. And so not only do we have to pay for the war, we have to pay higher interest rates on the national debt because of the war. So it's going to be very expensive. And even if we win the war, how much is the peace going to cost us? How much are we going to have to spend rebuilding everything we blew up? I don't know. But this war is going to add hundreds of billions to the national debt. I mean, maybe over $1 trillion. And assuming the war situation does not improve, we are still fighting this war 6 months from now. Oil could be $125, $150 a barrel. In that environment, we have to be in a recession. Mm-hmm. And the markets will be a lot lower. Now, the question is, when does the Fed cave in? When does the Fed recognize how weak the economy is and then start cutting rates and printing a bunch of money? I would think that over the next 3 to 6 months, gold would have already reversed and will be back above 5,000 and moving higher in response to people figuring this out.
So there is Peter Schiff laying out the full picture, and the implications are staggering. A housing market more overvalued than 2005 or 2006. A stock market in a bigger bubble than 2008. A commercial real estate sector seeing delinquency rates worse than the great financial crisis. A national debt heading to $50 trillion before this presidential term ends. A consumer already using buy now, pay later to buy food. And a bond market that is starting to reject US treasuries even during a war, which is the moment yields should be falling, not rising. And layered on top of all of that, an Iran war that Schiff says the US is going to lose by attrition. The Straits of Hormuz functionally closed. Oil heading to $125 or $150 a barrel. Hundreds of billions in additional war spending piled onto a debt load that is already mathematically impossible to repay. Schiff is not hedging, he is holding gold and silver, he is holding oil stocks, he is holding agriculture, emerging markets, international tech. He has been short the US dollar for 20 years, and he is positioned for what he believes is the final collapse of the dollar-centric global system. Gold above $4,650, silver above $75, the 30-year treasury approaching 5%, commercial real estate defaults at all-time highs. Recession odds at nearly 49% according to Moody's, a consumer on borrowed time, and a war in the Middle East with no clean exit. The question is no longer whether the next crisis is coming. The question is whether it will be bigger than 2008. Schiff says it will be far worse, and the data right now is not disagreeing with him. Stay informed, stay prepared, and make sure you are subscribed because we are tracking every development as this unfolds.